Hello, I'm Dell and Graham of Graham Wealth Partners as part of CG Wealth Management. Today on Deskside with Dell, I'd like to talk a bit about IPPs, that is individual pension plans. Most of us use our RSPs, which is retirement savings plans, because they are quite simple. They are defined contribution plans, which means is what is determined is the amount of money you can put in them every year. It's 18% of earned income up to, well, this year, up to a maximum of around $31,000. They are simple because you know that they are tax deductible in the year that they're put in. The assets are tax protected when they're in the actual account, and they're taxed as income when they come out. Now, they're also very simple to administer because basically you have a tax receipt for the year you put them in, and of course, they are taxable on the way out. But in between time, they're very, very simple. Now, in the case of IPPs, individual pension plans, things are a bit different. These are very specific to corporation owners, and that is typically professionals like doctors, dentists, and lawyers and that sort of thing, as well as business owners. They are defined benefit plans. What that means is that what is defined is the benefit that's paid at a certain period. So if you think of it like auto workers union, those guys know that at 65, they get a certain amount at a certain time, and they take comfort from that. That's the same thing with an IPP. The advantages of an IPP for the company are that they can have a tax deduction when they make a contribution for a plan member, which is good for the taxes. They can also use it for some tax planning. So they can use it as an opportunity to get rid of some passive income in the corporation and qualify for the small business deduction and lower their taxes on their active income. Also, the corporation can also use it as an opportunity to purify the corporation before sale and qualify the capital gains exemption on the sale. Now, the benefits for the actual plan member on an IPP is that typically the money that they can get in the plan is higher than with an RRSP. And it also is helpful if your retirement income or your retirement assets have underperformed or you've waited quite late in your career in order to start making payments. Those are the advantages. Disadvantages is that whether a fund is underfunded or overfunded is determined by an actuary. So an actuary must make calculations every few years, typically every 3 years, in order to determine how much you can put into the plan every year. Now, of course, you don't really know what kind of deduction you're going to be getting, number one. And number two, that makes it much more complex to administer and, of course, much more expensive. So those are the advantages and disadvantages. But if you'd like to explore how an IPP might work for your corporation, please contact me below and we can talk and take a look and see if this could actually work for you. Thank you, and talk to you soon.